Hey everyone. So the markets, well, they're not exactly looking sunny right now, are they?
Yeah, it's definitely a bit of a roller coaster out there.
And I bet a lot of you are wondering, what do I do with my money now? Should I even be investing?
It's a common question for sure.
So today we're going to dive into some strategies for investing when the market is down.
We've got this great excerpt, right? It focuses on some specific stocks, ones that might actually do well even when things are a bit shaky.
And hopefully by the time we're done here, you'll have a better sense of how to approach things, how to think about your investments, uh, and maybe even feel a little more confident about making some decisions. Sound good?
That's good to me.
All right, so the first thing this excerpt really hammers home, it's like a giant flashing warning sign, is
Don't just jump in head first.
exactly, you got to do your research. Really dig into a company before you even think about buying their stock.
And maybe even more importantly, talk to a financial advisor.
Okay, so why is that so crucial, especially now?
Well, markets go up and down, right? That's just the nature of things. But when things start going down, it can get pretty emotional.
Fear sets in.
Exactly. And when you're making decisions based on fear, you're much more likely to make a mistake.
Makes sense. So a financial advisor can kind of help you stay level-headed.
Yeah, they can help you step back, look at the big picture, and really figure out what makes sense for you, given your own goals and your risk tolerance.
All right, so that's step one. Don't panic, do your homework, and talk to a professional. But let's get to the good stuff. Let's talk about some specific stocks.
The excerpt breaks things down into three categories: defensive stocks, value stocks, and growth stocks with strong fundamentals.
Okay, so defensive stocks. Those sound like, I don't know, hunkering down building a bunker.
Well, not quite a bunker, but they're the companies that provide goods and services that people need no matter what's happening in the economy.
So even if the world is ending, we're still buying these things.
Let's hope it doesn't come to that, but you get the idea. Think like toilet paper, toothpaste.
So basic consumer staples.
Yeah, exactly. And the excerpt specifically mentions a couple companies in this category. Procter Gamble, for example.
They make, what, Tide detergent?
Tide, Crest toothpaste, Pampers diapers, all that good stuff.
Stuff you're going to buy no matter what.
Exactly. People always need to brush their teeth, right? And do laundry.
Okay, so that's one example. What else is in the defensive stock category?
Well, Coca-Cola.
Now, that's something I definitely buy no matter what the economy is doing.
Right. It's a classic example. Even if people are cutting back in other areas, they're still going to grab their favorite soda.
Okay, so consumer staples definitely makes sense. What else is in that defensive category?
Healthcare is another big one.
Okay, so drug companies, hospitals, that kind of thing.
Exactly. People are going to get sick no matter what's happening in the market, right? So companies like Johnson & Johnson, UnitedHealth Group,
They're probably going to be pretty stable.
they tend to be, yeah. And then there's utilities.
Utilities, you mean like the electric company?
Yeah.
The gas company?
Yep. Companies like NextEra Energy, Duke Energy. Everyone needs electricity. Everyone needs gas.
So yeah, they're not going anywhere. Good point. All right, so those are defensive stocks. What about, what was it? Value stocks?
Value stocks, yeah. So these are companies that the market might be undervaluing right now.
So they're like on sale.
Kinda, yeah. It's like finding a designer dress at a thrift store. It has the potential to be worth a lot more than what you paid for it.
I like that analogy. All right, so who are we talking about here? What companies might be good value picks right now?
Well, the excerpt mentions Berkshire Hathaway first,
Berkshire Hathaway, Warren Buffett's company, right?
the one and only.
So is that a good pick?
Well, Buffett's known for buying companies that he thinks are worth more than their current stock price.
So basically, we're just betting on Warren Buffett's judgment.
Well, kind of. It's more about the underlying value of the companies in Berkshire's portfolio, which is super diverse.
Okay, so you're not putting all your eggs in one basket. That makes sense. What else do they mention in the value category?
JPMorgan Chase.
A bank. Why would a bank be a good value pick right now?
Well, as the economy recovers, financial institutions tend to do well.
Okay, so you're kind of betting on a future rebound.
Exactly. JP Morgan is a big player in the financial sector, so they stand to benefit quite a bit from an upswing.
Interesting. What's the last one they mentioned for value stocks?
Walmart.
Walmart. Really? What makes them a value play?
Think about it. When people are worried about the economy, where do they go to save money?
Walmart. Got it.
Right. So even in a downturn, they do pretty well. But then as the economy recovers, people have more money to spend.
Walmart benefits again. So they're kind of winning on both sides.
Exactly.
Okay, that's pretty cool. All right, so we've got defensive stocks and value stocks. What was that last category again?
Growth stocks with strong fundamentals.
Growth stocks. So these are the ones that are going to skyrocket even when the rest of the market is tanking.
Well, hopefully. The idea is that these companies have so much growth potential that they're going to outperform the market even during tough times.
So are we talking high risk, high reward here?
They're not necessarily high risk, but they're definitely not cheap. You're paying a premium for that growth potential.
Okay, and who are we talking about specifically?
The excerpt focuses mainly on tech giants: Microsoft, Alphabet, Google's parent company, and Amazon.
Okay, big names for sure. But why Microsoft specifically? What makes them a good growth pick?
Well, their cloud computing business, Azure, is absolutely massive, and it just keeps growing.
So as more businesses move their stuff to the cloud.
Microsoft rakes it in.
Right, okay. And they've got other stuff going on too, right?
Oh, yeah, tons of stuff. Office software, Xbox gaming, even hardware like Surface tablets. They're pretty diversified.
So multiple ways to win. What about Alphabet? What makes them a good growth bet?
Well, they pretty much own online advertising, right? Google search, YouTube.
Yeah, it's hard to imagine a world without Google.
Right. And they're not just resting on their laurels. They're investing heavily in things like cloud computing with Google Cloud and artificial intelligence with DeepMind.
So they're looking to the future. Smart. Okay, and last but not least, we've got Amazon.
The everything store.
Exactly. What's the growth story there?
Well, e-commerce is obviously huge for them, and they just keep getting bigger. Prime membership, their delivery network, it's all incredibly efficient.
And profitable, I'm guessing.
Very. But
Yeah.
then you also have Amazon Web Services, their cloud computing arm, which is a major moneymaker.
It's kind of amazing how they've managed to dominate so many different areas.
Yeah.
All right, so we've covered the three main categories: defensive, value, and growth. But before we wrap up, the excerpt also talks about some important considerations for investing in a downturn.
Right. And I think the biggest one is diversification.
So don't put all your eggs in one basket, even if it's a really shiny, exciting basket.
Exactly. No matter how much you love a particular company or industry, you want to spread your investments around.
So different companies, different sectors, different...
Different asset classes, different geographic regions. The more diversification, the better. That way, if one area takes a hit, your whole portfolio doesn't go down with it.
Makes sense. And they also talk about having a long-term perspective.
Yeah, this is huge. Investing, especially in a downturn, is not about getting rich quick. It's about patience. It's about weathering the storms and letting your investments grow over time.
So don't freak out and sell everything when the market dips.
Exactly. Ride it out. The market always recovers eventually.
And speaking of riding things out, they also mentioned something called dollar cost averaging. What is that exactly?
It's a really simple strategy, actually. You just invest a fixed amount of money at regular intervals.
So like every month I buy, say, $100 worth of stock.
Exactly. And you do that no matter what the market is doing. Whether it's up or down, you just keep investing consistently.
Okay, and why is that a good strategy, especially in a downturn?
Well, when the market is down, your money buys you more shares. When the market is up, you buy fewer shares. Over time, it all averages out, and you end up with a lower average cost per share.
I see. So it kind of smooths out the bumps along the way.
Exactly.
All right, I think we've covered a lot of ground here. Hopefully, all of you listening out there feel a little more equipped to navigate this, let's just call it an interesting time in the market.
It definitely is. And just remember, this is all just a starting point. Do your own research, talk to a financial advisor, and make sure your decisions are right for you.
Couldn't agree more. All right, that's it for this deep dive. Stay informed, stay calm, and as always, happy investing.